The market is closed and we're looking at a last reported price for Intuitive Surgical Inc., ticker ISRG, of $462.74 as of the close on Tuesday, October 21st, 2025 at 4 p.m. Eastern Time. This figure represents an after-hours surge of over 17%, or a jump of $78.98 from the official closing price, an absolutely significant move that completely resets the near-term trading narrative for this medical robotics giant. This is not a slight uptick, it's a monumental reassessment of the company's immediate growth trajectory, and that's where the unexpected insight begins. Most of the commentary you'll hear will focus simply on the headline earnings beat. Non-GAAP EPS of $2.40 smashing the $1.99 consensus, and revenue of $2.51 billion outperforming the $2.41 billion estimate. That's the expected narrative. The deeper reality, the part that actually justifies a 17% after-hours leap and is driving institutional activity, isn't just the beat, it's the specific source of the beat and the subsequent raising of their full-year guidance for Da Vinci procedure growth to a range of 17% to 17.5%. The unappreciated truth here is that this massive procedure volume growth, 20% year-over-year, combined for Da Vinci and Ion systems, directly addresses the most persistent skepticism surrounding Intuitive Surgical, that the installed base of their Da Vinci systems was nearing saturation, and that capital expenditure by hospitals was beginning to slow down. The market worried the recurring revenue engine was sputtering. This quarter's procedure growth, far exceeding expectations, screams the exact opposite. It confirms that the utilization of their existing 10,763 Da Vinci systems is accelerating dramatically, and that is a far more powerful and sticky revenue driver than system placements alone, because instruments and accessories revenue, the high-margin razor blade business, soared 20% to $1.52 billion on the back of it. The common understanding of Intuitive Surgical stock is that you're buying the undisputed leader in robotic-assisted surgery, essentially a monopoly protected by intellectual property, a massive installed base, and the significant training costs hospitals and surgeons face if they were ever to switch to a competitor. It's seen as a safe, expensive growth stock, a classic buy and hold for the wealthy investor or for those with an intelligent portfolio who can stomach the high valuation. The challenge to this belief and what this massive after-hours move signals is that for the past year, the cost of that undisputed leadership, specifically the high price-to-earnings multiple, had baked in an expectation of continued high, but perhaps slowing growth. Investors, including those who may use platforms like Interactive Brokers to trade global stocks, had priced in a deceleration. The reality now is that the company is demonstrating a re-acceleration of its core business, a renewed vigor driven by the adoption of its newest system, the Da Vinci 5, of which they placed 240 units this quarter, more than double the 110 placed a year ago. Furthermore, the Ion endoluminal system, their platform for minimally invasive lung biopsies, grew its procedure volume by a staggering 52% year-over-year. This is not a mature company coasting on past success. This is a technology leader finding new, high-growth veins within its existing ecosystem and demonstrating that hospital capital budgets for proven cost-saving and outcome-improving technology are very much alive. Looking at the recent stock movement, the ISRG chart has been choppy. Leading up to this earnings report, the stock had been consolidating near the lower end of its 52-week range, which sits between $425 and $616. The recent downturn, which saw the stock fall approximately 10 to 15% from its earlier 2025 high, was fueled by general market anxiety, geopolitical concerns that can affect hospital capital expenditures globally, and critically, the aforementioned doubt about Da Vinci system saturation. The high trading volume in the after-hour session shows a massive scramble to re-establish positions following the blowout report. Institutional owners who account for over 86% of the shares, names like Vanguard and BlackRock are among the largest, will be adjusting their models significantly. We've already seen Larink, BTIG, and RBC Capital raising their price targets substantially, with some now in the $600-$685 range, which is essentially the high end of the 52-week range and then some. This rapid repricing tells you the sophisticated money was caught off guard by the strength of the procedure volume, particularly outside the U.S., where growth remains robust. This kind of sudden shift is precisely why individual brokerage and self-investing accounts, whether through Fidelity, Robinhood, or SoFi Invest, need to be constantly aware of the market's underlying expectations versus the company's delivery. When a high-quality name like Intuitive Surgical delivers a 20% beat on its primary growth metric, the corresponding share price reaction is violent and unforgiving to those on the sidelines or those shorting the stock. The underlying business model of Intuitive Surgical is elegant and highly defensible, which is what attracts long-term capital from Fidelity Investments and other large asset managers. The company manufactures and sells the Da Vinci surgical system and the Ion endoluminal system, but the real profitability comes from the recurring revenue. Think of it as a premium printer and ink model. The systems themselves, the printers, are capital sales, generating initial but lumpy revenue. The ink, or the high-margin revenue, comes from the instruments, accessories, and maintenance contracts that must be replaced or renewed after a certain number of procedures. This recurring stream makes up the majority of revenue and is directly proportional to procedure volume, hence why the 19% Da Vinci procedure growth and 52% Ion procedure growth are the single most important data points in this earnings report. As the installed base of systems grows, now over 10,700 for Da Vinci, the recurring revenue base becomes larger and more predictable, acting as a powerful financial engine. It's a classic moat business. Competitors exist, of course, but overcoming the clinical track record, the training infrastructure, and the massive installed base is a multi-year, multi-billion-dollar challenge. The company is spending money on share buybacks, with $1.92 billion used to buy back 4 million shares in the quarter, which is a significant signal of management's confidence in the long-term value of ISRG stock and the ability of the business to generate significant free cash flow. This is a common strategy utilized by companies whose fundamentals are strong, and it can be a positive sign for investors who like to invest online or use platforms like Schwab Intelligent Portfolios. Looking ahead, the future outlook for Intuitive Surgical is now considerably brighter than it was just 24 hours ago, primarily because of the accelerated adoption of the Da Vinci 5. This new system offers better computational capabilities, more surgeon autonomy, and a host of improvements that drive utilization, the true source of high-margin growth. This product cycle is now in full swing, and it is acting as a powerful and unexpected tailwind, especially as hospitals replace or upgrade older systems. This replacement cycle, which RBC Capital noted marks the beginning of a multi-year trend, is a massive potential catalyst. Furthermore, the Ion system, with its application in lung biopsy, a critical area for early cancer detection, is showing dramatic growth, suggesting that Intuitive has successfully extended its leadership beyond general surgery and into interventional pulmonology. The risks, however, are still present and cannot be ignored, even in the euphoria of a massive beat. Valuation, even after the run-up, remains a factor, trading at around 71 times trailing earnings. Any stumble in procedure growth or a successful new product launch by a major competitor could quickly deflate that premium. Another risk is the macroeconomic environment. Should hospital operating budgets tighten globally due to a deep recession or sustained high interest rates that make capital purchases more expensive, the growth rate of system placements could certainly slow down. But the current data strongly suggests that the cost-benefit analysis for hospitals, which includes shorter patient stays and better outcomes from minimally invasive surgery, outweighs these macro pressures for now. The tension between expectation and reality is this: the market expected Intuitive Surgical to manage a slowdown gracefully. The reality is that they are accelerating into an expensive multi-year product and procedure cycle, with the Da Vinci 5 and Ion systems defying the saturation narrative and forcing a massive upward revision of growth expectations. This is why the stock is seeing this dramatic move. The question now for investors, whether you are managing an intelligent portfolio, using the Fidelity mobile app for trading, or leveraging SoFi's active investing tools, is whether this acceleration is sustainable or if this quarter was a one-off pull forward of demand. The fact that the company raised the full-year procedure guidance suggests management believes the momentum is real and will continue. The analyst community, which was largely bullish but cautious, is now scrambling to catch up to the company's reality. This dynamic of under-promise and over-deliver is the perfect setup for a high-quality growth stock to sustain a premium valuation. The company also just received FDA clearance for AI enhancements to the ION system, integrating artificial intelligence into the navigational workflow, which is a subtle yet significant detail that underscores their long-term moat. They aren't just selling hardware, they are integrating software, data, and machine learning into the surgical process, making the ecosystem even stickier. This continued focus on integrating cutting-edge technology into their platforms, similar to the relentless innovation you see at Tesla stock or Nvidia stock, is what maintains their leadership position in the long run. The ION system's 52% procedure growth and the strong system placements,